thank you once again for coming out. For those of you joining us on Spreecast tonight, we appreciate your being here. And I forgive the lag. It's our first time with this technology. We've done our best to make this work well for you, but we know we have a glitch. The screen, for example, we understand you're not going to be able to see very well, but after tonight's presentation, if you'd like to see the PowerPoint deck that we use, feel free to email me at steve.beeman@societyforfinancialeducation.org, and I'll send you those PowerPoints right out. I want to thank First Harvest Financial Services for offering this wonderful space to us once again and for sponsoring tonight's event. So I want to thank the folks at Harvest for bringing us, and also the people from Meetup who have organized so many nice things for us around the country. This is new to us in the Chicago area, but we're excited to see it grow, and as our friends from around the country join us, we're pleased to use Meetup. Now again, my name is Steve Beeman. I'm the host for tonight. I'll be your presenter. I am the founder and the chairman of the Society to Advance Financial Education. We are all about empowering people with the economic and financial knowledge that they need to thrive and prosper in what is a tumultuous era. We know with globalization taking place, with the transformations in the American economy, with technology, we understand that people are afraid and they're concerned about what's going on. So we established the society to help promote financial and economic literacy. We do have a couple of things for you tonight. For those of you joining by Spreecast, we'd ask you to send us an email to register. We do have our registration forms here. We also have a summary of our consolidated insights, and these are articles that we have written to try to help people understand issues they face. We've talked about the importance of savings, how to calculate retirement savings, on into is Uncle Sam going to annex your 401k. So we think that they're important articles, and we would welcome you to take those. We also have for everybody here a brief introduction to the society. It gives you a little bit of insight into what we're about, so we hope that you'll use that. So with that said, let's get started right away, because tonight's presentation, following on the foundations that we built last week, we talked about the foundations of money. Very simple, very misunderstood concepts of the debt nature of the monetary system. We had an opportunity to jump a little bit of our agenda and go ahead into sector rotation strategies and some more advanced concepts. But tonight we're going to come right back to the fundamentals. We're going to talk about building and operating financial plans. So the first thing we want to look at is, why do we need to build a financial plan? Again, it seems so common sense, but if I go out and I talk with 100 people from ages 18 to 80 and I say, do you have a financial plan? The answer is no. And I think Tim, who is the president of Harvest last week, commented that for every 100 people who come in here, about 2 of them have a financial plan in place. Well, it's our goal to show you tonight that you need to have one, regardless whether you're 18, 25, 50, or 80, you need to have one. And there are really a couple of big reasons for that. First, the analogies have been flying all over everywhere forever. But we know that the financial plan gives us a roadmap. And none of us are going to go on a trip if we don't know where we're going to go and how we're going to get there. I use stories frequently from when I fly airplanes, because I'm a private pilot. And one of the things you do when you're a pilot is you actively plan out every step of a trip, from when you hit. But one of the things that I had commented is that from literally when you get to the airport to the time you get done at the other destination, you've planned out every step. And you do that for safety, you do it for hope, and you actually do it because you learn to enjoy it as part of the experience. And so building a financial plan gives you not just that roadmap, but it does ultimately become part of an experience. We talked last time, you've had some pretty good success. You've done quite well in having the discipline to save money, but you haven't done it without enjoying part of that. And we find that when we can't get people to sit down and do thorough plans, it actually becomes enjoyable for them. And so it's something we want to stress. The other thing, it is a fact, and we all know that if you fail to plan, you plan to fail. I put it on the bottom of our slides because it's ultimately very, very true. But we want to talk about the starting destination. We all know where we stand today. We know, for example, that we have a vision of where we might want to be in life. Now, we also know that these things change, right? I can tell you when I was 12 years old, and this is a true story, I remember sitting outside of my parents' house in Fort Wayne, Indiana, and thinking as you do at that age, what will I do when I grow up? Well, I used to look up at the stars and I'd see the planes flying overhead, and I always dreamed someday to be on that plane with a briefcase. I had no idea what I would do. I had no idea how I'd make money doing it. But I thought, wouldn't that be a really cool vision of mine? So I began to live toward that vision. And sure enough, I made it come true. And that's how I spent the first half of my life. As I came through the second half of my life, that vision changed. And I started to see myself more in an ability to help people understand what they need to know and to give back, to educate. It's a totally different plan. I never thought I would do that when I was 12. But now it's part of my plan. So these plans that we have are extraordinarily dynamic, and they're filled with detours. So we start out with these images of what we want, and we do that because it creates hope. And one of the things we find from our plans is that hope comes from confirmation of goals. And what I mean by that, if you have a confirmed goal, you gain clarity. So if hope comes from confirmation, confirmation from clarity, if you can clarify where you want to be, it gives you hope because you begin to believe in the goal that you've set. One of the fascinating things that I've learned in my life is that, and we've all heard it, but it's the psychology of winning and the power of the attitude. If we can begin to see ourselves in our financial plan, we will begin to live it out. And therefore there's hope. So it doesn't just give us the roadmap, but it gives us indeed the hope. And if we look at it and we say, well, okay, we know that it's important for people. One of the things that we have, if we know that we want to build a roadmap and we know that we have reasons to do it that give hope, that give security for our family, the question drives down to why don't we do it? And if you've got 100 people walking in and 98 of them don't have a plan, there must be some reason we don't do this. But as we look at the reasons, we can talk about the fact that first and foremost, it's hard to do a plan. If you've ever had times in your life when you've been under emotional stress, you find that it's extremely tiring. I've been through a lot of tumultuous times in my life, and it's in those times that I find I have a hard time getting out of bed in the morning. I find myself more tired because the mental energy to any process is tiring. Building an accurate and fundamental plan for your financial life is no different. It's very complicated, can be, it's very tiring, and it's hard, so people don't do it. But I would suggest to you there are other things, that there is a fear that people have in doing this stuff. And they're afraid to do it because they don't want to look at the reality of a circumstance. They don't want to see the position they're truly in vis-a-vis retirement or anything else. And if you look at one of the statistics I'll talk about later, the average American today has $40,000 in their savings account for retirement. That's a scary number. So when these folks sit down to do a plan and they start at a $40,000 number, oftentimes they're afraid. They don't want to know the bad news. In fact, if we can make this all work, I'll show you a video of a woman who's talking about how it creates fear in her to even think about the future, so they don't do it. But we also know that there's an embarrassment factor that comes in. When I spent time as a retail broker, I had many an occasion in which a person would come in and they were embarrassed by their financial condition. They could be successful doctors, successful lawyers, professionals, but they had more debt than they cared to admit. They had credit cards they didn't want to talk about. They had financial problems that they couldn't understand. In fact, one of our directors is an accountant who runs a CPA firm. And he's got clients who make $200,000 and $300,000 a year and they're fundamentally broke. Well, they're always embarrassed to come in and talk to him. They don't want to sit down and disclose the dirty laundry. But money has strange bedfellows, and it's a strangely important thing to all of us. So people tend to be not just afraid of the outcome, but embarrassed by their situation, so they don't do it. But we know, if you go out and measure, for example, if I were to poll everybody, both watching and in the public, and say, what are the most important things in your life? Virtually everyone would say, my health, my family, my friendships, my ability to survive and do what I want to do, and inherent in that stuff is your financial position. So the question comes down to, why don't we do it? Because it's hard, because we're afraid, and because it's embarrassing. But we've got to change that behavior. We're going to talk a little bit about financial plans and why they're so mathematically critical, but we've got to do it. And the question that I always get is people saying, well, when do I have to do it? I'll start next week. And the reality is we want to start now. You've got to start tonight, because there's no way to keep pushing it off down the road and then come out where you want to go. Again, I go back to my flying experiences. When I was flying, I used to sit down a week before a flight and conceptualize what I was going to do. Because you've got to check all of the component parts. Financial planning is no different. You have to check all the component parts. And we think folks should start now. My son, who joins us tonight, is 17. I have a daughter who's 19 at the University of Baylor. I believe they both should be starting now with their financial plans. I know that we have people that are going to join us either tonight live or will be reviewing our video tonight that have young families. I've talked with them. They need to start now because they're taking on additional responsibility. If you're older and if you're retired and you've got a spouse, you need to be thinking about things for that person's benefit. None of us lives in a vacuum. So we need to take the desire to have the plan, eliminate the fear of building one, and begin to do the work now. And it is no matter where we sit, we have to understand again that these plans that we put in place are dynamic. They're going to change over time. My son's plan, who's entering college in a year, is going to be very different than a 30-year-old's plan. His plan at 30 will change and be different. His plan at 40 will be different. His plan at 50 and 60 will be different. Laws change. Things happen. Things cause us to want to change these plans that so fundamentally must be put in place. And we all know it, but again, we don't want to do it. In business, there's one old axiom that I believe to be truth, and that's the only thing that's stable in life is change. It goes on. How many people didn't have plans in place in 2007 that by 2009 were totally changed? Now, it's not unusual, right? We do it in business. And in fact, one of the funniest comments ever made, I had a private equity company, and so I looked at lots of business plans. One of the truest but funniest comments is, if you want to make God laugh, you show him a business plan. And it's true, because they rarely, if ever, play out. But in that planning process, you have the opportunity to think through the issues that should be looked at. We're going to talk in a little bit about risk. And one of the benefits of having a plan is that you can logically think through the risks without the kind of immediacy that has just thrown upon you. And there are a lot of risks that we're going to look at. But as we get started with this concept of a plan, I want to talk about two concepts, two financial concepts. One of these is the need to understand compounding interest. Now, I've used this story many times, and I think it's a commonly used story, but if we go out and we ask a question, if I were today to say to you, I will give you either $1 million in cash, or I will give you 1 penny and double it every day for 30 days, which do you want? Okay. Anyone who understands this will take the penny. Because while the million sounds good and a bird in the hand beats 2 in the bush, that 1 penny doubled for 30 days goes to about $6 million. And if you have 31 days, it goes to $12 million. That's compounding interest, and it can play for you or it will play against you. To those who might have credit card debt at 18%, I guarantee you it's playing against you, because it will compound down as fast as it compounds up. So compounding money is a critical concept. The second thing to understand is the difference and importance of two things in your life, your assets and your liabilities. As I've talked to people around the country and I talk about assets and liabilities, I find fundamental misunderstandings of what they are. People look at a house and say, that's my asset, which truly that is an asset. They look at their bank account and say, that's an asset. But they fail to realize they are as well an asset. There's a human resource there that has the ability to earn income. And that is an asset. They may have time, which is a precious asset. We don't think about it, but it is. And when we conversely look at liability, people will come up and say, yes, my credit cards are a liability, but they forget that their mortgage is a liability, a true one. That house has variable value, the mortgage doesn't. But they have other liabilities. The liabilities we don't think of. In governmental concepts, we always hear about what are known as unfunded liabilities, promises that have been made but aren't yet funded. Well, our average American with $40,000 in the bank has an unfunded liability of about $250,000 of their own making. Because that's about how short they are of achieving their goal of retirement. So we have to look at our liabilities as well and understand that while they may not show on paper, they're real. We also have to be realistic about the risks that involve in our lives. Because if we have assets and we have liabilities, we also have risks that can transition those very quickly. Again, I go back to the housing crisis. We had a house that was worth X and a mortgage worth, X minus something. In a matter of months, it inverted. So the risk of the implosion we had was real. And as we build plans, we need to learn to look forward to the risks. As we sit here today, we expect the sun will come up tomorrow. We have a lot of history that would show that it would. But we don't know that we won't have a terrorist attack. We don't know that one of us sitting here or joining us in the virtual world won't get hit by a car. We don't know that driving home tonight I won't get pulled over and shot by a mugger. We don't know the risks that we face often. So we need to plan to say, well, what's the probability of this risk? How do I mitigate this risk? And can I make money on it? And that's often misunderstood in the world of the people that we deal with. When you talk to folks on Wall Street, they don't like to take risk. The big money banks don't like to lose money. So they spend hours and hours and days and weeks and months with very skilled people, very educated people, looking at all of the possible risks that could be accruing to that dollar that's invested. But do we do that? No, we don't. But we need to, because our future and the future of our children depends on it. And then the other thing about risk that we need to understand is a fundamental thing called a surprise. We're driving down the road one day, this just happened to my daughter. A young friend of hers was driving down the road, and in the oncoming lane, a trailer unhitched, headed right for him. It's a surprise. Nobody could have predicted it, but it's a surprise. Risk is very tied to that. And so in looking at the plans that we have, we need to understand, yes, we have this goal to achieve. Yes, we have these assets to help us get there, these liabilities to help us not get there or prevent us from getting there. We have these risks that we can mitigate. Not to be, Ben Franklin, I think he said it very well one time. He was asked, Mr. Franklin, what do you recommend to people as a life concept? And he said, well, very simply, I think you should pray like you're going to die tomorrow and save like you're going to live 100 years. It's highly true, right? We're balancing the future to the risk. So as we go forward on our plans, the probabilities that these risks will happen, we need to understand, we need to take into account. But again, people don't plan, therefore they get surprised when those things happen. They incur the risk that they hadn't seen coming, and they get hurt. And the planning process is meant to help them. Now, the one thing when we talk about risk, and I'll share this too, you've all heard me use the phrase perma-bull and perma-bear. If we think about risk, pardon me for a minute, I'm going to grab a pen. And we know that the world goes like this. Nice stable things down the middle. Well, there are people up here that want to work with you, especially those of you who are looking at investment advisors. There are people up here that are the permabulls. Oh, the market always goes up. Come on in, let's work on this together. Well, they're right, once every so often, right? The market tends to go up 70% of the time. But they live in this space negating this. And these are the perma bears. Peter Schiff comes to mind. What's his name? Mark Faber comes to mind. These guys, and I used the analogy last time, they're like broken clocks, right? You have the broken clock. It's right twice, just by the nature of it. The perma bears are like that. So as you look at risks in your portfolio, you want to avoid becoming a perma bull or a perma bear, and it's easy to do. If you listen to the news, and I don't care, pick your channel, right? They're always playing in this space. And it depends who the political leadership is. Same channel flip-flops. And what happens is that mindset gets put on us. There's an old saying in the commodities pits that if it's raining in Chicago, it's raining all over the world. And that's because the emotional mindset of the traders was set by their own environment. Well, I assure you, if in your financial world, you're putting all of your thoughts down here, you're going to be buying all gold, right? You're going to have a huge stash of food sitting around because it's all coming down. We're going to have an EMP attack and the world's going to come to an end. Well, the reality is it's not going to happen, probably. Yes, there's a 1% chance of it, but you don't want to overbank your financial life on this bet. Same as up here. I'm an eternal optimist. I believe that things will get better and things will grow, but I can also share with you that I'm not so much up here that I don't recognize the numbers. I was talking here at the offices earlier about the fact that in the last 100 years, America was the economic growth engine of the world. We had huge stock market returns because of it. We had a lot of wealth built in the United States because of it. But in the next 100 years, wealth won't be built in the United States like that. It'll be built in South Africa. It'll be built in Asia. That's not bad. It's just different. And if I get too much of a panacea vision of, my own environment is what's going to bring me home, I'm ignoring the facts. What we want to do is avoid both of those positions as we go through development of our financial plans. And then the other thing, and I circled a special note here, one of the things a plan will do for you is that it helps you avoid the charlatans. And they're all over the place. The promisers of fast, quick riches who want to take your money. In virtually every Master of Money session we've ever trained, I talk about this because it's so close to where my heart is. I go to meetings and seminars with other companies who promise quick money. They could be real estate people, they could be day trading people. They are trying to sell a seminar for $2,000 to bring you in to teach you the secrets of Wall Street. A thoroughly drawn out plan will prevent you from getting sucked into that. And these charlatans that I talk about are a constant threat to a person without a plan. Because if you don't have a plan, you have no hope. And if you have no hope, you're going to be subject to these people calling you in. So it is a fact of the matter that risk can entail many things. The charlatans are there. But I want to take a look at a basic circumstance. And as I said, I want to look kind of at an average individual. But I'm going to give you some averages. As I said, if we look at a 40-year-old, and we're going to have people younger than that, older than that, whatever, but an average 40-year-old person, they have in the United States today an average income of $43,000 a year. So they're taking home $3,000 a month, $3,200 a month. They have, on average, let me get the numbers right, $40,000 in their retirement plan and $3,600 in liquid money, checking, savings, accounts. Less than one paycheck away from destruction. That's the average American. Now, if we look at the average American assets, they have a home that's valued at $160,000, and they have debts that are approximately $90,000. Again, these are average numbers. But it paints a very interesting scenario. This is actually the video I wanted to show you last time. I'm going to go ahead and play it. They captured this whole retirement concept, I thought, really well.
Let it rock. I don't know how I will retire, but I intend to one day.
Sweetheart, there is nothing under the bed.
Here it is, the monster. Okay, 20 years from now, I will be 62. I will be $32,184 in debt.
I think a good retirement for the American public is pretty much a fairy tale at this point. Every day we have 10,000 baby boomers reaching retirement, collecting their Social Security benefits. Social Security is bankrupt.
What? Young people have come to wonder what would be their lot when they came to old age.
Social Security got going without anybody thinking about who's going to pay the bills.
Retirement should be a three-legged stool. There should be some personal savings, a pension, and the guarantee of Social Security.
It's like we don't even really know what that looks like. There's all these social structures that we've relied on in the past. Pensions, this idea of working in a company for 30 years and retiring. We're on sort of the last generation of that.
The third pig planned on touring the Enchanted Forest in an RV.
My grandparents have an RV.
Bet your granddad has a pension.
No, it's a Winnebago.
What is it drinking?
Well, my retirement plan right now, called a life insurance policy. No, my retirement plan right now is Social Security. I have a 401k with not enough in it.
You're hungry.
It's funny because I did hear my wife in my ear right now. What are we doing about that?
I don't think there'll ever be a retirement. I see what my mom is doing at 72 years old.
We're looking at a much greater financial burden on Social Security than it once had. It's obviously supposed to be the first leg of the stool, not the whole stool.
We have a nice view.
When it comes to having to move,
I'll miss it.
it's exhausting. If this continues for 6 more months, we have to make radical life changes. Oh, we got a problem, honey.
I think about where two old people will end up. No.
We're going this way? It's a moral issue. I'm actually nervous. If the ultimate test of a moral society is the world we leave our children, our grandchildren, this country's failing and failing miserably at it. I can answer Nick Triana.
You can't solve big problems with what fits on a bumper sticker. Maybe you should just give up the notion that you get to retire. Change what you do. Incoming.
Everyone's living longer. You can have people who are retired for 30 or 40 years. Is that a sustainable system over a long period of time? We need to have an adult conversation in this country around the issue of what does retirement mean?
There's always a time to save. Reset the clock and start back at square one and move forward in a new way.
Happily ever after isn't what it used to be. Retirement is no fairy tale. It's another kind of story altogether.
That was a longer video, I think, than most people would want to watch. But it highlights the problem that we've got. And it highlights the reason this society exists. The fact of the matter is, if you look at that average person I was telling you about with $40,000 in the IRA, Social Security will pay out to them on average about $2,000 a month. That's just not a very good lifestyle. But unless some radical changes are made to that individual, they're not going to have the resources to benefit or to plus that up. So I want to go forward. I've covered some of this. Let me get to the core of what I want to talk about, and this gets into the future lessons that we're going to teach. Because if we look at that 40-year-old person who has $40,000, I drew out some scenarios on what kind of a chance they've got and what their opportunities are. So let's look at scenario number one. That person becomes disciplined, and they put away 5% of their net income every year toward their retirement beginning today. And furthermore, they're able to generate a 5% net return, net of taxes. that person's in real trouble. They're going to end up broke at about 80 years old. Because by the time they retire at 67, they'll start burning down their capital, and they won't have enough money to continue. So you say, okay, if 5% return and a 5% investment won't do it, what are my options? So let's raise it to a 7% return with a 5% contribution. 7% is not easy. The historical average return of the U.S. equity markets in the United States for the last 100 years has been about 8.5% gross. So 7% is not easy. But now it's better because they've returned a little more and the compounding effect kicked in. Now they probably have enough to last until 90. But they've bled through everything they have. Here's the third scenario I ran. Let's assume that that person doesn't save another dime, but they're able to generate a 9% net return on their money. So they didn't save any more. They became a more prudent investor. That person now is the best case, and they can live forever. Because if they compound up that $40,000 at 9% a year, that sustains, that will generate enough income they never have to burn through an ounce of capital. The point we should take home from that is that the knowledge of investing money and what to do with saved money is real. And that's where America sorely lacks. They go out to people on the internet or people they hear on the radio that want to sell them just pure mutual funds. That may be fine, but they don't understand what they're buying. My former partner, who stayed with Schwab long after I did, used to go on the road for Schwab. And he'd go to Schwab investor meetings all over the place. And he said the most frustrating thing for him is that the people didn't understand what expected returns should be. They'd come out of the 90s, they'd come out of the 2000s, they thought they could expect 12, 13, 14%. Well, that's simply not true. If you look at the structure of returns, and this is something we wish everybody would understand, you first of all have to look at the value of a dollar. On average, over a long period of time, a dollar deflates at about 2% a year, which translates to you as inflation. So goods cost 2% more every year. So the cost and value of investment money is predicated largely on that. A treasury bill is designed to keep you steady state with inflation for the most part. So the safest investment you can do, a treasury bill, is going to pay you about inflation. So now you say, all right, I want more than inflation. I want inflation plus growth. You say, I'm willing to take a little additional risk, so we go into the bond market. And they're very efficiently priced from single A up to triple A or the junk bonds. You get an interest rate very specifically related to the higher risk you take. But you're going to average there in today's world 3-4% in corporates. So then you say, well, I'm trying to get that 9%, so I'm going to have to be in the equity markets. The question then becomes, how do you generate a 9% return in the equity markets when they don't even average that over a long period of time? Now, it can be done, but it takes being savvy and understanding of what's going on. And going to the get-rich-quick schemes won't get you there. For every 10 people who go out and do the day trading thing, 9 of them lose. And they lose big. And the one who makes the money is the one who sold the seminar. So I urge you, as you go out and you look to the importance of a plan, to put it in place, don't get caught up in, gee, I think I'm behind the 8 ball, I have to go react by going into a seminar. The money that's made will not accrue to you, I assure you. So if we look at this person and we say, look, we can get you to retirement, but you've got to increase your level of understanding. You can't just go out and do the buy and hold thing. If we, again, look at fundamentally America from 1900 to 2000, the growth engine of the world Do we really think that from 2000 to 2100 the same dynamic will hold true? It's not possible. That doesn't mean the returns won't be there, but it means we have to look other places for them. We have to be opened up to global investing. We have to look at different strategies on U.S. stocks. Another fallacy that I like to rip apart. I get often told, you know, Warren Buffett's the greatest investor of our time. He's averaged 17% a year. That's a misstatement of fact. Warren Buffett has not averaged a 17% a year return. What he's averaged is 17% a year return on equity. So his businesses have returned 17% to their shareholders. It's very different than the stock price. We talked about this last time, where you have an analyst who goes out and predicts a stock earnings. Doesn't mean the price is going to respond to that. So all of these things come down to the fact that when you look at your plan and you say, just in general, here's where I stand today, here's where I want to be tomorrow, I back into what's the least amount of risk I can take to get there. Most people are going to find they have to generate superior to market returns to get there. And that doesn't happen if you follow the pack. It just doesn't. Now, the other thing that we would want to talk to folks about, if you take a look at third scenario and say, I think I know what I'm doing, I'm pretty good at what I do, I have good people I trust, I think I can get to 9%. Well, we want to add a dimension to our plan that talks about risk again. What happens to that 40-year-old if, God forbid, 5 years from now they're unable to work? Well, now that $40,000 gets bled down much sooner. Or they have a medical problem that's even more catastrophic. Those risks need to be mitigated as part of our plan. And as we look forward to planning, we need to find counselors to help us, and I'm a big proponent of finding counselors because part of our plan needs to have a will. What happens when we die? What do we bequeath to our future generations? But this is all part of a comprehensive plan. And if you don't have it put together, we run the risk of never achieving the goals that we set. So we have got to get a plan done and then start to mitigate risk. You know, I wrote down just a few of them for fun. I was looking at, what's going to happen with that individual with inflation. Like Tim Newell, I talk to people every day in the industry. There isn't one of them that doesn't think inflation's ready to pop. The only question is how big. If the Federal Reserve is extremely schooled and skilled at what they do, we'll maybe see real core inflation at 3 or 4%. The fear is that it's going to jump up to 10 like we had in the 70s. What does that do to a portfolio? Stocks tend to lag that stuff. You go back to 1979, we'd had, and you guys remember the 70s, we had this hyperinflation that started when we came off the gold standard. And the fact is, by 1980, 79, 80, Business Week wrote, their biggest selling issue ever, the death of equities. How inflation has killed the U.S. stock market. Because stocks may not be the place to be on a buy and hold if you're going to have inflation. This person needs to put that in their plan. First of all, are they going to receive Social Security? I don't believe Social Security is bankrupt. I think that's a misstatement by an academic who looked purely at the raw numbers. The fact of the matter is, we can sustain Social Security, but it's going to change. I'm 52 years old. I will not plan on drawing Social Security until I'm at least 67. At least. If not 70. And I think as you back up from me down to 40-year-olds and 30-year-olds, they're going to have to look to 70 years old. If we do that, the system sustains. It's a pretty mild change. I think most Americans wouldn't mind that change. Because if we don't do that, the second thing that'll happen is they'll means test it. And that's a frightening concept because it hurts the savers. If you've been prudent in your life and you've saved your money and you provide now for your own retirement, the money that you put into Social Security will not be paid back to you because you earned too much to get it back. I don't think anybody wants to see that. So my bet is we'll just see it paid out a little bit later, but it's a real risk to a person they should look at. Medical care. We now have a Medicare system in this country that is broke. Medicare is just busted. It's not as bad as Medicaid, but it's getting there. Should anybody at 50 years old, at 20 years old, at 65 years old be looking at whether or not they're going to get Medicare? So these risks, one of the things I wrote is disability. And Tim, you would know the numbers of the people who walk in here, how many carry disability insurance?
Less than 10%.
But that's a high risk. So as these plans evolve, we're not only doing it to get us to a vision of life and to create hope in our lives and to mitigate risk, but we're doing it to think through those things that could completely derail and decouple us. But again, we don't do it because we're afraid, because we're embarrassed, all of these things, but we must. And if anything shows it, it's a simple example, like a person who's 40 years old with $40,000 put away. You may have a grandchild who's just starting out. Interesting phenomenon, I was telling my kids about it. If I start them now in an insurance program, we're going to talk about insurance programs next week. We're going to go into some details on different ways to use insurance. But if we look at that at their ages now, and I put them into a small $100 a month type program, by the time they're my age, they'll never have to work again. So why don't we do that? Why don't we do these things? It's because most people don't know to do it. But starting them early on a plan will prevent them from being in the position the average American's in. And that's what we don't want to see people. The other thing I think this relates to, and it's why I put them together, is the extent to which we should hire an advisor. And that begs several questions. First, what is an advisor? Because there are all kinds of people out there who hold themselves off as advisors and aren't. But we also want to look at whether or not I'm the type of person who should use an advisor. Some people should, some people shouldn't. So let's look first at what is an advisor. And let me suggest to you that there's some real easy benchmarks here. One of the fascinating things that's evolved since I was a broker in those days is that advisors have migrated out of transactions-oriented business into fee-based businesses. So the true advisors are going to have a fee. And the average fee structure in the United States runs about 1% of assets. Now, I'll give you an interesting sideline to that because this is something that I've dealt with dozens of times as I go around speaking. People have an image and an impression that an advisor is going to get rich on their money. Think of the math. That $40,000 pot that our young average American puts aside goes to an advisor. The advisor's annual fee for that is $400. That doesn't even cost to cover the cost of liability insurance. One of the reasons you'll see advisors increasingly taking people with only $500,000 and up is because at 1% of assets, they literally can't make money on people with less than that. And we can blame our regulators in Washington for pricing small investors out of the business. But the fact is, not all transaction guys are bad, but true advisors are going to be fee-based. And they do that, obviously, so they're in bed with you on the same objectives. We don't want to have an advisor who's at counterproductive odds with their client. And by having them in a situation where they are on a fee basis, they will. The other thing to look at is their fiduciary standard. And this is something that gets heavy in the 401k market. We're going to talk much more about this in a whole program we do. But there is a very real fiduciary requirement for advisors to serve in certain markets, the 401k market being one of them. As you evaluate an advisor, talk with them about their fiduciary standard. Find out where they stand. What designations, licenses, certifications do they hold? Because we find that many of those who hold themselves out as advisors do not hold the appropriate fiduciary licensing. So you're being shortchanged. So we look out and say, what is an advisor? Fundamentally, a person who is aligned with you and your objectives. But we look to a fee-based advisor as opposed to a transactions-based advisor because they're lined up with your interest. And again, it's not to say all transactions are bad. I think most fee advisors still engage in some transaction business because it's the appropriate way to do it. But in a nutshell, we want to look at an advisor who goes into a fee base. Now, once we do that, if we say, okay, I kind of get an advisor, I want somebody and I want to find somebody who's aligned with me, who's got the fiduciary standards, who's on a fee, how do I know I line up with them? And one of the constraints that we talk to people about is understanding your own style bias. In the world of money, all of us have a bias. You can be a value-oriented person who likes to buy cheap, or you can be a growthy person who likes to buy growth. In my life, I'm a growth person. I had one of my partners who was a value guy. We're both right, we're both wrong, and all that. It's not about that. But in selecting an advisor to work with us, we want to look at their style. Is it consistent with our vision of life? If I'm a deep value player, and I believe I only want to buy things because they're traded on assets and cash values very low, and I hope the multiple will expand, and that's how I make my money. Okay, that's a very different model than the guy who says, well, we buy companies because their earnings are rapidly growing, and all we care is a constant PE ratio as long as those earnings keep growing. They're both valid, they're just very different. And we would urge people, as they go in to talk about advisors, to go in and find out their style, their theme, their methods. The other dimension is, are they one of three different things? And there really are probably three different ways to look at the world in this sense. Are they fundamentally driven? And we talked about this last week. A fundamental analyst or a fundamental investor is going to look to that company, to their financial statements, to their cash flows, and they're going to try to draw from those financial statements what they think the stock price will do. That's a fundamental approach to investing. You can make argument all day it's the right way to do it. That's a Warren Buffettish concept. The difference being he doesn't invest, he buys the company. The second way is what you might think of as a quantitative manager. They are purely looking at the stock price reaction to the data. In other words, and we touched last week, I don't care if a company has whoppingly high PEs, if whoppingly high PEs drive stock prices up. I'm looking purely at stock price response to those fundamentals. Some fundamentals are drivers of stock price behavior, some are not. Again, PE is an example of a predictive variable. Low PE stocks do tend to correlate with higher returns over a long period of time. But other things like pure earnings growth, it doesn't correlate to returns at all. Companies with declining earnings have prices that go up just as much as companies with rising earnings. So does it really matter? No. What matters is what drives that stock price. And the third thing are the technicians, and these are people who care not so much about the stock, not so much about the fundamentals, but care about the investor's psychology. And if you study technical analysis, it's fascinating. What they're trying to do is determine the behavioral pattern of the public investor or the institutional investor. It's a very attractive concept. And they've developed all kinds of alchemy around 10-day moving averages, 50-day moving averages, the Bollinger Bands, whatever you want to draw, because they find that people do behave as cattle. One goes this way, everybody wants to go that way. And so the technicians tend to look purely at stock price behavior. They can do it on the stock or the market averages, it doesn't really matter. They're not looking at the companies at all. Some managers blend them together. I think we talked last week about Harvest Financial Services and their sector rotation strategy. They're blending a quantitative, mathematically driven approach with a technical overlay, in a sense. They're concerned about the momentum of things. That tends to be, in today's market, a very practical and viable strategy. Will it always be? Maybe not. But it has been for a long time. And momentum does tend to pick up the herd mentality. So it becomes a very viable way to forecast stock prices. Going back to my days at CIA, we had three core models. Value Alert, which looked at deep value. Growth Alert, that looked for pure growth. And then Momentum Alert, which looked at short-term momentum. Anybody want to guess which one gave the best return?
Probably momentum.
By a lot. Now, we juiced it up. We also built a surprise forecaster model that looked to next quarter's earnings surprise. We predicted the surprise. When you tied it together, it was a very, very good return. But the momentum thing is a blending in a sense. You're looking at the technical volume indicators, but you're also looking at the data. Do the numbers on this company match what I think they are? And when you talk to advisors, when I ask people around the country why they are upset with their advisor, more often than not, they should never have been put together anyway because their themes of life don't match. And what we want to find are investors who have advisors who blend. And if we can find that, we typically will have a good relationship. Yes, there may be downtimes where the money doesn't return as we wish it did, but we all will understand that. And fear and understanding go hand in hand. So if we can look at the type of manager we have, the style of investing they do, the type of vision they have of the marketplace, if it's consistent with what we have, we are then going to be able to ride out that storm with them and not have a situation in which we panic and throw in the towel. And if you're going to charge for returns over and above market averages, you have to learn to do that stuff. You've got to make educated bets. You've got to be able to say, this is my strategy, here's why I'm employing it, knowing full well it may not work all the time, but over time, so many out of 10 it will. And if you and the advisor are on the same page with that, you'll have a good relationship. But if you're not, if they're going this way thematically and you're kind of this way, it'll never, ever work. So we want to find an advisor who can play in the sandbox with us, who has the fiduciary standards, has the fee arrangement, and doesn't have the embedded conflicts of interest. Again, when I was a broker, I'll tell you a true story. I had a retired couple come into me once. They had 1.2 million, as I recall it. And this was the day we talked last time. The interest rates were up at 13 and 14%. I went out to their home one night. Stoner was their name. And I talked with them at length. And by the end of the night, I sold them $1.2 million worth of CDs, long-term CDs. The commission to me was zero. The return to them was 14, 13% for a long time. I took the ticket into my office the next day. Within moments of submitting it, you could hear from the corner office, I march in, because I marched in, and there's 3 of the senior guys, you're an idiot! Because I could have sold them Franklin funds, a nice bond mutual fund that was paying out that year 15%, and had an 8% ride on it. I'd have made a $96,000 commission. But would that have been the best thing for the client? No. Now, I'm not suggesting brokers inherently do things against the interest of their clients, but I do think you have a perverse incentive sometimes. And a true advisor will partner with you. And a 1% fee, find me any other valuable thing you can get for 1%. It's just not a lot of money. The people I tell not to go to advisors, and I will, and I have told people this, are people who fall into this camp of highly arrogant, highly oriented toward, I know everything, no one can, I have certain people close to me who are like this. I already know it. I know more than they know. They can't do anything for me. Okay. Find me a company without a board of directors. They don't exist. How can we not look at ourselves as a company? I want my board of directors. I want my investment professional. I want legal advice from time to time, accounting advice from time to time. If I can get those services for 1% of my assets, I'm thrilled. Because my assets will grow much, much faster than they would have otherwise. But if I'm one of those persons who wants to go it alone, so be it, let them. That's the way they operate. So, we talked a little bit about why we should build a plan, why we don't build a plan, the effect of a plan, and I cannot stress enough that it keeps us from making those snap decisions that we look back and go, I wish I hadn't have done that. Again, find me any business. They're imperfect and they may be the way to make God laugh, but find me a business that doesn't have an operating plan. You know the best one in the country is at this? The Defense Department. They've got a plan for everything. No matter how remote, they've thought it through. And the reason is they don't want to panic, right? They don't want this to happen and say, oh my goodness, now we're going to panic. But we do that all the time because we don't have a plan. And again, when you fail to plan, you plan to fail. Next week, we're going to talk about insurance. I want to talk about life insurance. I want to talk about annuities. I want to talk about variable policies, the risks that are there inherently to them. I want to talk about some of the upside to them because I happen to be a believer in life insurance products. I know if you talk to Susie Orman or Dave Ramsey, they'll quickly tell you, buy term and invest the rest. I don't disagree with them that there are costs to this. But in terms of causing people to put money away for retirement, I think it's a very viable strategy. And some of them are better than others. We'll hopefully be able to give you some specific names on ones to look for. Because we're going to keep going, deeper and deeper and deeper. As we look forward in the Master Money series, I think 2 weeks from now I may do a real estate one. We may look at the different parts of the country, what's going on in real estate. 3 weeks out we may do day trading and get into some of the really technical day trading ideas. Maybe week 4 we'll go into financial analysis and how we look at stock, company financials to pull out stock picking facts. So we're going to keep going and just get deeper and deeper and deeper. But to date, we've covered kind of the foundations of the money. We've covered the idea of building a plan to determine where you want to go. Next week, we want to start talking about how we fill in that plan. So thanks everybody for coming out. I'm sorry for our Spreecast members that joined us that we didn't get this to work on Spreecast. We will work that technology for next time. But again, we thank you for joining us for this Master of Money program.